It is a great pleasure to welcome to this conversation Stephen Penman, the George O. May Professor Emeritus and Special Lecturer at Columbia Business School, as well as a distinguished professor at Bocconi University. His book, Accounting for Value, as well as his new book, or I should say, new edition, Financial Statement Analysis for Value Investing, are truly volumes that should be on every intelligent investor's desk and should be read carefully. Because what I found Stephen, is that they're very applicable to actual investing, as opposed to a lot of accounting books that will teach you accounting, but aren't going to be as applicable to the craft of investing itself. So thank you very much for sharing your wisdom in that way.
Yes, I think that's right. We try to write the book in an active style, rather than just explaining investing, explaining accounting, valuation models, cookbook stuff. We put it in a very active investing style. If you want to be a fundamental value investor, here's how to approach it in an active way, and particularly with dealing with the accounting involved.
And so the new edition came out just some months ago here in 2025. What motivated you to write this new edition to update your insights?
Well, let me just correct you there. It's not a new edition of a previous book. I have two previous books, one which is more of a textbook style called Financial Statement Analysis and Security Valuation. That's been around for, I think 2001 was the first edition. That was published by McGraw-Hill, who have decided not to proceed as a textbook. Their textbook publishers now are into the big mass market edition, so they didn't want to proceed with the sixth edition. So this is instead of that. It flows on somewhat in terms of ideas from another book called Accounting for Value, also published by like this book, this new book, by the Columbia University Press. But it's not a continuation. It's actually written in much less a textbook in style rather than an active investing book. Having said that, it is very much designed also for a textbook in the style with the opinion that students being active about investing will grab students, okay, just not gathering knowledge, but actually thinking about how to do this on a practical basis. So it's also a textbook with a lot of additional materials on the website for professors and so on. I should say it's not just my book either. It's co-authored with Peter Pope, who's a colleague also at Bocconi University. So it's a joint effort here.
Terrific. And maybe just lay out some of the core messages, I'll say, or topics that you sought to cover with the book.
Okay, well, that's going to be a long answer, but I'll give you some one-liners to help you along there. The book is it's about active value investing or fundamental investing, as we say, but it's about how to go about it. Now, when I think about value investing, as most value investors do, the first thing you think about is the business. Okay, what's the business model? Where's it going? What's its strategy? How can I think about what the business is going to look like in 1, 2, 3, 4, 5 years ahead? And I think that's the most important aspect of value investing. First of all, understanding the business. But the book is not primarily about that, although it's in the background there and it refers back to it. No, it's really about then once you understand the business, you think it's a very good business. Let's get some quantification going to get it expressed in terms of numbers, dollar numbers or euro numbers, whatever you want, which you can actually then employ to actually think about dollar or euro prices. And that's the accounting. We call that accounting, pulling the information together, how you pull that information together in an efficient way to actually understand you think it's a good business, but I want to get an assessment of what it's worth to understand whether actually the price at which it's trading is the price to pay. Now, that's, of course, all standard value investing. So there's nothing new there. Where the book is innovative, and I think it is quite a different book, is in a number of ways. The first way is we don't like valuation models, okay? At least as they're typically applied. The idea that you can forecast free cash flows for, 5 years, 10 years, 20 years, discount the free cash flow value and get a thing called intrinsic value, we think that's rather a fool's errand. Forecasting into the distant future is very, very difficult. The book has a wonderful quote that took from Charlie Munger, Warren Buffett's sidekick, or more than a sidekick, which he says, the idea that you use valuation models to forecast the future, discount back, he says that's not the way to do it. He says that he has a sentence there where he says, that's what they teach in business schools. Well, they've got to do something. Okay. So it actually says valuation models are really not for valuation. Valuation's a way of thinking about valuation, direct your thinking. And in doing that, it differs from the standard way of doing, which is discounted cash flow analysis, which we call cash accounting. It uses balance sheets and income statements. The rough model that outlines this is the residual income model, where you think about the balance sheet and adding value to the balance sheet. But it doesn't plug in discount rates and growth rates and pretend you're getting the intrinsic value. In fact, we say in the book, it's probably best to think that you cannot find the intrinsic value. It's a very elusive notion. Benjamin Graham actually said that many, many years ago. It's a very elusive notion. So what we do is we adopt the approach, which is, I think, goes back to Rappaport and Mollison way back, the reverse engineering approach. We do it a little differently from them. We say, okay, here's the price that the market is asking you to pay today for NVIDIA, for Microsoft, for any of them, okay? Do I want to buy? Or do I want to sell? And then to begin a process by saying, to answer that question, I don't go independently and try and find an intrinsic value and use a valuation model which has very doubtful inputs. Now, what is the growth rate you put in the long-term growth rate? It's very hard to get hold of. So we say, okay, let me understand the thinking in the market price. And so it uses the valuation model to understand how the thinking in the market price. This is very traditional approach in value investing. Benjamin Gray, if you go back to security analysis, if you go back to his books, he talks about investing as being a matter of negotiating with Mr. Market. What do you think about it, Mr. Market? And how does that compare with how I think about it? But first, you've got to understand what is his thinking. And so that's the approach taken. And once you understand his thinking and using it to understand, the big thing is understanding his estimation of growth in the future. Then you can start your fundamental analysis by then pulling your accounting together, pulling your analysis together, doing your fundamental analysis. Well, he thinks that there's likely to be a growth rate of 7%. Well, can I actually, knowing the business, can I actually think, yes, that's reasonable, because I think that the sales implied in that, the margins implied in that are actually reasonable, or otherwise. And so that's the way to approach the task. Now, other themes in the book, there's a standard theme. Valuation is a matter of accounting. One accounts for value, and how you do that accounting in challenging the market price, in challenging Mr. Market's estimate of the future is an accounting matter. And how you do the accounting is valuation is a matter of accounting for the value. That requires, of course, you understand accounting, but it also requires that you actually use good accounting. So there's a couple of chapters, more than a couple of chapters that deal with, well, if I want to use US GAAP accounting or IFRS accounting, is that good accounting? Well, a lot of it's good, but here's some things you have to watch out for. And so it is instruction about how you actually do your accounting in a way with integrity that gets you onto, makes you secure and gets you onto proper foundations. I can go on. There are many other themes that.
Well, let's just get into some specifics here, perhaps on the topic of earnings quality. A lot of value investors swear by cash flows, but accrual accounting could also reveal value creation, maybe even more reliably. So I'm wondering if you could talk a little bit about, accrual earnings, kind of following the realization principle and using them versus raw cash flow.
Okay. Well, that's really to the point of accounting for value. Discounted cash flow analysis using cash flows, free cash flows it's cash accounting. It's what's going to throw through the cash flow statement. And as you say, accrual accounting says no, the focus is going to be on balance sheets and income statements. The investments you put in place and what they're going to earn, okay, to cover your cost of capital. Then it says, well, why would you want to do this? Well, there are a few reasons. First of all, discounted cash flow analysis forecasts free cash flows. Now, free cash flows are cash flows from operations. We like that stuff, net cash coming in, minus investment. That's the free cash flow after you reinvest in the firm. Now, from an accounting point of view, that's rather strange. That investment is treated as a bad. Cash flow from operations minus cash investment. So the more you invest, and growth companies invest a lot, the lower your free cash flows. Now, ultimately, that investment will turn back and generate positive cash in the future. But in the long term, we're all dead. Forecasting what's going to happen in the long term is very difficult. Forecasting more than 3, 4, 5, 6 years gives me severe psychological problems. So accrual accounting says, hold it. We're not going to treat those investments as a bad. We're going to generate a balance sheet, and we're going to put those balance sheets on the balance sheet. Now, we don't do that with all assets. We don't do that with all investments. We don't do that with R&D. So there's an issue. Then it says, look, when we recognize the earnings, in doing that, recognize the earnings, we're going to use accrual accounting. So if you're using discounted cash flow analysis, forking cash flows, and you've got a pension scheme where the cash flows won't happen until 30 years hence when the employees retire, that gives you a hell of a forecasting problem. Where the accrual accounting says, hold it, we'll do this for you. We'll actually recognize the liability to do that on the balance sheet. So it's there already, booked for you. You don't have to forecast it for the very long term. And at the same time, we'll recognize the associated wages expense committed this period from actually making these promises to employees. So that's the way, in some sense, what it does is it brings the future forward in time. So you're not stuck with this big problem of forecasting for the very long term or developing a valuation which rides on a terminal value where the terminal value is a very high proportion of the terminal value, which deals about speculation of the long term, is typically, even for a mature company, is actually usually very high proportion of price. Starbucks, which is now a very regular company, if you try to value that, 90% of the valuation is in the terminal value, and you've got to come up with a growth rate and plug it in. And that one's a tough one. We want to avoid that. So we want to get to a situation where there's more reliance on what you see now, the earnings and the book values, and maybe the near-term earnings that you can get grasp on, and then without that reliance on that long-term, minimize the long term. And accrual accounting does that for you because it brings the future forward in time and gives you a more secure valuation.
Now, accrual earnings can be manipulated, even cash flows can for that matter. But what red flags or quality checks do you recommend investors look for in financial statements to guard against aggressive accounting? For instance, are there particular signs such as unsustainably high accruals, one-time gains, or big gaps between earnings and cash flow that would signal that earnings may not be actually translating into genuine value?
Yeah, you're right. There's the rub, as we say. Yes, accrual accounting in principle gives us better grasp on the value generation. However, most accruals are subject to estimates, and so there you have some issues. Now, we do have institutions to deal with that. We have auditors. We have audit committees. We have boards of directors. We have the SEC sitting there with just some protection, but of course these sometimes fail us. So the book then says, well, there's a couple of chapters there. It says, here's what you've got to watch out for, and here are the diagnostics to actually assess whether the accruals are good quality or not. Yes, the accruals versus the cash flow is one of them. If you get putting high receivables and you're getting little cash from your customers, hey, you better go and check that one out, okay? But it points out also the balance sheets and income statements balance sheets as well as income statements are important for the quality of the accounting. So the way we think about the balance sheet as a quality balance sheet is one that cannot come up back and hit you later. If you look at the residual income model, which is the basic framework here, the balance sheet goes into price 1-to-1. There's no discount for it. There's a discount for the risk to future earnings, but not to the balance sheet. So that tells you the balance sheet has to be a safe balance sheet, a safe anchor, okay? There's nothing there that could come back and hit you later. So what can go wrong? Well, up to a couple of years ago, operating leases were on the balance sheet. That's going to come back and hit you later. At last, they've got that straight. Fair value accounting, let's watch out for that, okay? If they're writing up assets and they're reckoning things at fair value, unrealized, okay? You mentioned the realization principle. It's unrealized, it's still at risk. Risk is only resolved when the asset value is realized. Off-balance sheet liabilities, the leases being an example. The off-balance sheet liability for contingent equity securities, the convertible bonds. The trick there of issuing convertible bonds, recording at face value, and having very low or no interest on the bonds, with all the cost of the shareholders coming on a generous conversion, where the accounting doesn't record that cost to the shareholders, that's something that's going to come and hit you later, because when those holders of the convertible bonds or preferreds exercise, they're going to dilute your equity. So these are accounting issues that have to be dealt with. That's the balance sheet. Now, the income statement, a quality income statement is one that there's nothing in the income statement that can reverse later. Okay. underbooking allowance for bad debts or overbooking revenues has to come back and hit you later. A quality income statement is one where if in fact the firm is going to be exactly the same next year as this year, the reported income here now is the income you're going to get. There's nothing there that's actually going to affect you. And so there's a lot of diagnostics on that. There's a lot of diagnostics for sales, a lot of diagnostics for warranties, a lot of diagnostics for depreciation, and so on and so forth. And so the analysis is always done with these diagnostics. Now, having said that, typically US GAAP and IFRS is pretty good accounting with some exceptions that are pointed out in the book. And most times, everything looks okay, or most looks okay. But it's very important to actually understand that in your fundamental analysis, you're anchoring on really safe accounting. One aspect of it is, I really believe, you mentioned the realization principle. Yes, let's have the realization principle. Don't book earnings until you get a customer. Fair value accounting goes against that, of course. In fact, that's the whole part of the history of the whole value investing. Back in the 1920s, firms routinely wrote up assets because it was boom time, or the assets are worth much more than the accountants have on the books. We've got to write them up. And then one day in October 1929, the asset values crash. That was the beginning of Benjamin Graham's insight. John Maynard Keynes also, who lost a lot of money in the 1920s. He became a value investor. And what they said demanded is no more water in the balance sheet. You put water in the balance sheet, it can evaporate. As indeed fair values did in the global financial crisis and a lot of financial institutions, with the taxpayers left on the hook. So that's sort of that. So the demand. Let's stick to the realization principle. Don't recognize value until it's everything's safe. Now, and that also tells you if it's not recognized yet, you and me and I, as an investor, we can anticipate that and put it into our price. Just realize that revenues and earnings are not yet recognized are still at risk. You might want to think about that.
Now, we often want to find the red flags, but if we wanted to actually identify businesses that are conservative in their accounting, what would we look for, or what are the usual ways that managements can be very conservative and still stay within what's allowed by GAAP?
Well, GAAP itself is very quite conservative, actually, and unless until you got into the movement towards fair value accounting, which the regulations, both the SEC and the standard setting boards, have withdrawn from. They're basically only applying it to certain marketable securities and derivatives. So just be assured that the basic accounting is conservative, but then you have to look for those firms within within GAAP are being more conservative. They have a lot of conservative allowances for loan losses. They have a lot of conservative in banks. They have a lot of conservative in terms of their depreciation, which writes off assets quicker and gives you lower profits. You recognize these firms are being conservative. That's nice, but the opposite side of conservatism is if you're conservative now, you're going to be less conservative later. So if you have low depreciation now, it means the asset's going to be fully depreciated before they actually economically depreciate. You can have higher earnings in the future. So conservatism, excessive conservatism is sometimes bad. basic conservatives, I want to be conservative. Yes, if in fact I've got receivables, I want to make sure I discount them conservative and not get in a situation where I'm overestimating the profits. But I can be too conservative too. I can be aggressively conservative if you wish. And that's going to be looked at also because that means that, yeah, they've written things down. Impairments are very good example. When firms take impairments, they often do excessive impairments, big baths. That often happens when there's new management in. Oh, well, we're going to change the strategy. We're going to write down. They write excessively. They write down assets, which means there's less expenses from those assets, from the inventory written down, from the plant written down, to give you higher profits in the future. This is I wouldn't say as bad as going the other way and being aggressive on the upside, but it's something that has to be watched. Fortunately, some years ago, the FASB required firms, after excessive write-downs in the 1990s and early 2000s, required firms to have much more documentation to support their write-downs.
That's a great point, because when a business writes down too much, it's basically inflating its future return on equity metrics in a way, which
It
is
is,
not,
yes.
yeah.
Yeah, and it's actually recognizing a liability for the estimated restructurings, and this liability is something that never has to be paid. So you have to actually bleed it back into earnings to get rid of the liability. That's the impairment bleed backs, which increase future earnings. IBM was very good at this in the 1990s. Okay, they look very good, and actually, 1990s they were a great company, no complaints. But they excessively impaired in the early 90s. And that really increased their profits subsequently.
Now let's talk a little bit about leverage and risk in valuation. Your residual operating income model addresses the distortion that leverage can introduce to ROE and other metrics. Tell us just a little bit about how you address leverage.
Okay. Well, first of all, of course, we value assets understand leverage is risky. And most people understand leverage is risky. Just ask the shareholders of Lehman Brothers. Okay. They know it's risky and they suffer because of it. And it's very much in the finance theory, that leverage is risky. So one of the sort of rough rules of value investors is just watch you're not buying too much leverage, okay, particularly if the operations are risky. But there's a more subtle point I think you referred to, is that leverage affects a lot of the accounting measures that we typically use. So return on equity, for example, which we take as a measure of profitability for the shareholders. You can increase leverage increases the return on equity. But in theory, generally, it doesn't increase value. You issue bonds at the market price, okay, fair value. It doesn't change. It doesn't add value. Just trading bonds doesn't issue value, unless, of course, you're an arbitrage or bond trader. But it increases ROE. So, ask the question. You're on the board of directors, and the CEO comes to you and says, I think my compensation should be based on return on equity, return to the shareholders. And you say, well, that sounds good. Yeah, let's go for that. Well, it's a big mistake, because just tomorrow you're going to get a bond issue financing a stock repurchase to change the lever it, and the ROE is going to go up tremendously, but no value has been added. And now it's not just ROE that's affected. PE ratios, which we look at, one of the most common metrics, a PE ratio, is affected by leverage. I tend to ask my students when I introduce PE ratios, hey, If a firm issues debt, what happens to the PE ratio? Does it go up or go down? They don't know, of course, but their guess is it goes up. The answer is wrong. It goes down. More leverage gives you a lower PE ratio. The book takes you through it. It's deterministic. It's just how accounting works and prices work. And so, if you screen on PE ratios and you look at a low PE ratio, you say, "Oh, that's a low price stock. I'll go and buy it." Well, if it's due to leverage, then you're just loading up on risk. So, and there are many other metrics in accounting. Price to book ratios affected by leverage. They tend to be higher the higher the leverage. Well, looking at the price looks higher relative to book value, but it's only a function of the leverage. So you said it. Whenever you do valuation, you've got to unlever, get rid of the leverage, and work with the operations, the operating activities. And this is a basic distinction in finance, of course. This is Modigliani and Miller. Leverage, except in special circumstances, leverage doesn't affect the price of the equity. Get rid of it, okay, and understand the added value comes from the business activities, the operating activities. And so look at return on the net operating assets, look at unlevered earnings to price ratios, look at unlevered rates of return, and so on and so forth, and carry out everything on an unlevered basis. As it turns out, the leverage is pretty much clear already from the financial statements. Debt assets and debt liabilities typically are very close to value, okay? Unless there's been a big change in credit worthiness or interest rates and so on. So the debt seems to be reasonably priced. It's the pricing of the business that's the important thing. And to do that, you've got to make sure a very fundamental rule in value investing is in accounting analysis and financial statement analysis, separate the financial activities from the operating activities. Don't get them mixed up. Yes, there's debt there. There are maybe a large amount of debt assets like Apple, but any schmuck can buy a bond. Any schmuck can buy a CD. That's not where your value comes from. So that is the focus, and that gets over the mistake you can make by looking at levered accounting numbers.
When it gets particularly interesting is when the leverage is not your plain vanilla straight up leverage, but let's say non-recourse leverage of some sort where the equity has the upside, but kind of limited downside. And then in that case, maybe it would make sense to give the equity some credit for that non-recourse leverage given the asymmetry. How would we do that?
Well, I think it depends on what, in terms of generating the instrument, what you paid for it. If it's fair value that reflected all these things, it's going to be okay. Now, I think the case where leverage, we're looking at the debt is going to be important, is in fact when the financing transactions are not done at fair value. So if in fact you issue bonds and take the proceeds and buy back stock because you think your stock is underpriced, that's going to generate value, okay? So any trade, or if in fact you think, hey, my bonds are mispriced, so it's time I actually go and do that. This is the trick of firms in the times when the Fed puts interest rates low, and interest rates are very low. You've got very good credit ratings. You go out and issue some bonds, take advantage of that low interest rate. That generates some value. This is actually bond arbitrage. But if you're issuing bonds and you're issuing equity or repurchasing equity at fair market value, then that can't create value. Now, that's a theorem in finance. But the alternative, the contrary situation, of course, is yes, you do stock repurchase when you think your stock is underpriced, okay, and be careful not to issue stock when you think they're when you think they're underpriced, or overpriced, excuse me. So uh, there's a model there for actually gaining money from leverage. Now there's another aspect to it. There's a whole chapter in leverage. There's another aspect there for you. There's another aspect to it is value investors say, oh, be careful leverage, don't buy any leverage. But there's a time when, in fact, you might want to lever up because you're so convinced that the stock is cheap, okay, in the trading terms, there's alpha there, okay, that then you might want to lever that up. You might want to go and borrow and lever that up. Now, that's very risky. Okay, you've got to be very, very sure of your position in a real good margin of safety. You might want to lever that up. And that's an unlevered active investing fund, of course. But also, you might, if you've got two firms that they're both legally attractive, and you want to invest in them, the one actually that has high leverage is actually going to be more attractive because their leverage is going to give you, the firm's leverage is going to give you a higher return when in fact it all pays off. So the firm you can go into debt on private account, or the firm can go in debt on your on the shareholders' benefit. Just as you can buy a cheap stock when you think it's underpriced. But the firm also can buy back their own stock when it's underpriced on your behalf. The benefit accrues to the shareholders. And so the analysis goes through. These are exceptions. Now, the best place to start is there's no value added from debt. That is a starting point. And then you look at these situations where there might be, in which case you can do some debt arbitrage.
And also, I guess the tax code is another potential factor where maybe it favors some degree of leverage.
Yes, you've got it, and that is not recognized in the accounting. So if in fact now you issue debt and you get a tax deduction for the debt, which is now more limited than it used to be, you get tax, then there's a subsidy. There's a subsidy for the debt. Okay, that is potentially there, but you do have to watch out. The firm issues debt to get the tax benefit. They've got to sell it to someone. Let's say you or me. We have to pay taxes on the interest. Okay, so we might price that in. So it works both ways. It's not automatic that you actually get the tax benefit of interest deduction as a corporation, because you then have to put the stuff on other people who actually have to pay tax on the interest income they receive, and who don't get the subsidy, and that's going to be built into the price. That's a pretty thorny problem, actually, working that through. But it's not automatic that, in fact, that the tax deduction is a subsidy that flows directly to the shareholders. Okay.
Thank you for that insight. Now,
That
when it
insight is
comes,
not mine. That's actually Merton Miller, who was on the original Mediglia Miller, which actually talked about the tax benefit of debt. And then he came back in a later paper, in I think 1977, said, "Oh, hold it, I'm not sure I'm quite right on that." Okay.
right. Now, when it comes to accounting for risk in valuation, the traditional finance model would take a risk-adjusted discount rate, I guess, with beta in there. You advocate for a slightly different approach. So Could
Yeah.
you talk a little bit about that, please?
Yeah, I do. We do in the book, and I wouldn't call it slightly. I'd call it quite a different approach. Um, First
I
of
was
all,
being diplomatic.
okay. Yeah, who's listening?
Yeah, right.
Um, so no, it's very easy to take a model like the capital asset pricing model and say, "Oh, this gives me the discount rate. I'll just plug it in and go for it. Go for it." Um, but as Charlie Munger said, you can be worried about all models. Now, um, let me start with the story, which I think is in the book. Um, in the financial crisis, the global financial crisis of 2008, 2009, I was teaching the class, a valuation class, and Warren Buffett wrote a paper in the New York Times saying the S&P 500 had crashed. It dropped down to as low as 667, I think, at one point. Okay. So this is about in November 2008. He wrote a piece in the New York Times saying, now's the time to buy stocks. They're cheap. So I grab the New York Times, I walk into class, I waddle into class, and I say, hey, look, it's time to buy stocks. Are you guys buying stocks? And the students, no one said yes. And I said, well, why aren't you buying stocks? Well, Professor, we've just had this huge crash. We're basically finance graduates, investment graduates. This Columbia is basically a finance school, more so in those days. We don't think we're going to get a job. The world's going to hell. We got a lot of risk. Not only that, we got student debt, the ceiling. We're very highly levered. We just cannot take the risk. It was a very uncertain world. What's going to happen? If you can remember back there to November 2008, my goodness, is this the end of the world? Basically they're saying, I'm not buying stocks because my discount rate is infinite. It's very high. They turned on me and said, hey, Professor, are you buying stocks? And I said, yes, I am actually. I'm looking very closely at them all. But you've got to remember, first of all, I have a job. Okay. I'm not looking for a job. And actually, Columbia University is silly enough to give me tenure. And I cannot be fired unless I'm very, very naughty. I'm in a very secure situation. I'm not highly levered. So yes, it's time for me to, you and everyone else is running from stocks because of the risk. But also Warren Buffett, here's an opportunity. Another thing is saying is we have a different discount rate. We have a different cost of capital. We have a different hurdle rate. We have a different hurdle rate compensation for risk. So the first thing to recognize as a value investor is it's a very personal matter. Okay. You have one that's probably different from mine. Okay. The second thing is to recognize that adopting a model that gives you the cost of capital is really a fool's errand. We talked about there is no such thing as intrinsic value. It's good to think there's no such thing as intrinsic value. Well, to think that there's no such thing as a cost of capital that you can discover is probably a good way of thinking too. You think about the risks that firms face, except for your lemonade stand. There's a complexity of risk, particularly for international firms. There's huge risks they face, very risk. To think that you can funnel all those risks down into one number. Hey, John, it's 8.1%. It's not 8.6%. Okay. I think that's a fool's errand. And you say, oh, well, but we have these academics have given us these pricing models. One is the capital asset pricing model. Actually, that was quite a revolution in terms of thinking. Okay. that a lot of risk just comes from the sensitivity of the market portfolio because you can get diversification through Markowitz. Okay, it was a very good thinking. But then to have a model that says, now I can use this thinking to tell you, John, it's 8.1%, it's not 8.6%. I don't think so. And when you look at it, you start with the risk-free rate. Well, what do we use for that? Oh, we say in class, well, use the US 10-year bond rate, okay? Because the US government has never defaulted. Although, by the way, we're getting a little worried about that now, okay? But it's not risk-free. If, in fact, when interest rates were, the 10-year rate went below 1% at one time, okay, you need your mind read with all the money that was being printed that this was actually going to be the rate all the way through for 10 years. You're going to get inflation, and inflation devalues your bond. It's not risk-free, to be totally honest. And one thing we value investors try to be, is to be honest. Honest in our way we conduct ourselves, but honest in our thinking. And then it says, hey, listen, to get the CAPM cost of capital, you've got to have a risk premium. The expected return on the market in the future minus the risk-free rate. Well, the expected return on the market? Man, if you give me that number, you're a better man or woman than I am, okay? Well, what do they do? Well, you ask anyone. You ask the students. You ask, what? It's 5% or it's 5.5%. Why? Because that's what they teach in business school. Just use 5%. And don't ask me about it, okay? And the betas are estimated with a standard error as a 0.2, so the whole thing's very, very messy. And you know from a valuation model, if you change that discount rate by just 0.5%, you get very different valuations, particularly if it's combined with a growth rate you don't know much about. So again, in the spirit of being honest, the value investors have this creed: understand what you know and what you don't know, and don't base your valuation or your assessment on what you don't know. Admit that to yourself, and then think of how to proceed. And the way we proceed in the book, it says, well, you cannot expect a model to bail you out and say, hey, this is what I got in finance 120 course. No, you've got to go and make a business assessment of the risk. Pro forma it out on different set scenarios. What's the probability of getting this amount of sales at these profit margins? Let me get the distribution. I can tell you in fundamental analysis, we can tell you by doing that what the risk is, okay, in pro forma. I can't tell you how to map that into a number. John, it's 8.1%. Don't tell me it's 8.6%, okay? So that's, then once you've done that, then you apply your own hurdle rate, and yours may be different from mine. So I think that's being honest about it. We just don't know it. It's a dirty little secret, actually, in academia. We've been chasing the cost of capital, the discount rate, for, well, ever since Markowitz, 80 years, okay? 5 Nobel Prizes for the effort. But the dirty little secret is we just don't know how to calculate the cost of capital.
Very interesting. How should we rethink the concept of margin of safety if pinpointing an exact intrinsic value is problematic?
That's in the value investing creed, of course. Well, getting back to my notion of negotiating with Mr. Market. Okay, here's your price. I can do some accounting for value to tell you, give you an indication that will indicate to me what's your growth rate. Okay, to do that, I actually got to put in a hurdle rate, which has got to be my own hurdle rate. However, one way of doing the margin safety is, hey, listen, if I put in a higher hurdle rate, something that actually I think I'd be satisfied in this environment of getting 10%. But if I put in 12% or 13%, what comes out of it is a number that tells you the market's anticipating higher growth. And that's actually makes sense because if you have a higher discount rate, hurdle rate, you've got to have more more growth to cover the hurdle. Now, if in fact, once you've done your fundamental analysis and you see that Mr. Market's assessment is very pessimistic relative with that high hurdle rate, you have a margin of safety. So use it not as something you know the hurdle rate, but use it as as a a tool to give you a margin of safety. Okay, that's one way of thinking about it. The other way to think about it, once I do this fundamental analysis and see how far I am from Mr. Market's assessment, okay, um, let me go for the stocks where I think indeed there's a margin of safety. He's really quite wrong. Or let me avoid those stocks where I think he's really overpriced. Or short sell if you're into that game.
Now, on the topic of growth and value and paying for the future, I guess the basic message is that we should not pay or overpay, certainly for growth. Um, how does your framework help us think about companies that aren't really generating any profits at the moment? Uh, Basically, every AI company out there, except for NVIDIA, is not generating profits at the moment.
Mm-hmm.
And it seems highly uncertain what the future will look like for those new business models. So, can we even begin to come to any intelligent assessment of value, or does that have to go into the too hard pile?
The short answer is a too hard pile, but let me elaborate. I mean, you're right. One of the themes of the book is um, the heart of investment is buying growth. And growth, because it's growth in future earnings, which are not yet realized, the earnings still at risk. Growth is risky. So if you have a lot of growth there that you're buying, you assess you're buying a lot of growth in the market price there, you might want to think this is a more risky firm. So that's a good way to think about it. Okay, now you get to a firm, you get to a mature firm. Well, there's a lot there. I've got a history of sales and profit margins. I know the business. I can sort of model it out with a fair degree of comfort. But you get a firm which is, it's all in the distant future. Those firms that just say are not making profits now. I remember my students have asked me many times, when I was teaching at Berkeley during the dot-com boom, I was teaching financial statement. They said, Professor, how do I value a Silicon Valley startup? How do I value a biotech startup? Um, and I have to say to you, this is just something that I cannot tell you about. Look at the balance sheet. All you've got is cash and cash burn. Look at the income statement. All you've got is expensed R&D. No revenues as yet, very little revenues yet. I can't tell you much at all. Hey, here's a good clue. Why don't you go out and get a PhD in biochemistry and understand the science there, okay? This sort of analysis that we're talking about here, it's not for those companies, okay? But one thing I can tell you, that if in fact you want to pay something for one of these companies, you must have a scenario where in the future, sometime in the future, this is going to bang. They're going to get through phase 3. It's a very good drug, and so on and so forth. And you can model that out. Okay. But first of all, you've got to understand the biochemistry. And that's the primary thing. Doing financial statement analysis is not the name of the game, but I can tell you, you have to have that in the future. Now, if it's a long time in the future, it's growth. And more so, if it's growth a long time in the future, it's going to be a long time because you're going to get those earnings. You've got to recognize that that's a very risky company. You might want to have a very high hurdle rate. And it's like a venture capitalist. I mean, what are their hurdle rates? 25%, 30%. Even if they do it that way, it's got to be high. So I think again, it's a matter of being realistic. Pretend you can value with some analysis of accounting data can value a biotech startup. I mean, it's sort of misdirected.
Now, quantitative strategies and factor investing have become quite popular. You seem to bring a critique to the idea of trading on simple multiples or kind of smart beta schemes. What do those quant approaches miss in your view that an old-fashioned fundamental analysis can catch?
Well, I think you mentioned two things there. Let me deal with the latter one, trading on multiples. Hey man, that is pretty easy. Okay. You know, you can look at the price. You can actually look up the book value or the earnings, get a PE ratio, a price to book ratio, or price to sales ratio. And as long as you can do division, okay, so you have to get at least to fifth grade, then you can do it, okay? And you buy the ones that are low. Now, sometimes that works, but it's a hell of a risk. There's a motto, again, we emphasize in the book, a tenet we have in the book, ignore information at your peril. Trading on just one bit of information earnings, one bit of information book value, two bits of information earnings and book value, you've got to be very, very careful. You are in danger of trading with someone who's really done their homework. And so here we in this book, we can teach you this is how you do your homework. We're going to try and do it parsimoniously so you don't have to have thousands of bits of information, but you've got to do your homework. And in some sense, the book is about what you're missing out on, mistakes you're making when you do those quick cut uh, uh, analysis. They call it trading on PE ratio, price book ratios, value versus growth investments for low PEs and high PEs and low price to books. It's sort of silly. Okay. All investing is value investing. And you can buy a very high PE ratio as a good deal. So that's a very important point. And the question, therefore, is what else do you need to pull in to actually get you a better to get you a better trading strategy and to reduce the risk that you're not trading against someone who's done their homework. You mentioned value investing. Now, I read a little while ago, I think there's $1 trillion under management excuse me. Sorry, let me step back. You mentioned factor investing. I read some time ago there's about $1 trillion under management of factor investing in the world. Now, a lot of these factors, the very famous one, of course, the Farmer and French factors, and the multi-factor model. Well, the CAPM model we see that doesn't work. Okay, so let's add some other factors. How do we get these factors? Where we purely get them by data dredging. We go and say, oh, price to book predicts returns. We'll make a factor out of that. Firm size predicts returns. We'll make a factor out of that. ROE predicts returns. We'll make a factor out of that. And so these factors are formed in the Farmer and French 5-factor, 6-factor models just simply by data dredging. There's no theory, no understanding. Interestingly enough, they come up with accounting numbers. And when you do your fundamental analysis, you understand the accounting, you understand what they're picking up and what they're not picking up. Okay. So in my mind, it's a very crude approach, very crude, basically based on data dredging and not understanding the accounting. And when that happens, you can run into trouble. Now, it turns out, I'm glad you asked this question, because now um, uh, what I've been involved in the last couple of years is research developing an accounting-based factor model, which actually understands the risk that's conveyed by the accounting and building factors by the risk that the accounting is actually uh, uh, conveying. And you had the realization principle is very important. Yeah, the price is high, but it's not yet realized. What's the probability it's going to be realized? Okay. So, but I think that I'm a bit dismayed about the as I think most values, about the cheapness of a lot of strategies. Now, there are many good strategies out there, I'm sure, particularly on the buy side. We don't observe many of them. They're in the dark, okay? And there's many, many good strategies. There's many good fundamental strategies, many good quantitative strategies. But in terms of the ones that publish, the Morningstar style box, man, it's very crude. It's very crude. And the key is, yeah, you can throw asparagus at everything, but actually, what can you put on the table? And that's what we try to put on the table. But at doing so, we try to show what the errors you can run into if you don't get fundamental.
Well, certainly, it seems that often the tail wags the dog, or the marketing will drive the financial product that's created and sold. So it may not make the most sense from an accounting valuation standpoint.
No, we think of our industry, our finance business, which now has had a lot of achievements, particularly in terms of a lot of the risk-sharing instruments and so on. In some sense, it's an industry that's chasing AUM, okay? And any way of getting AUM through marketing, through any device and so on, is important. So if you have one good year, I mean, you display your returns. It's sort of it's an industry which is getting in the more naive retail investor, because the retail investor doesn't know about it, needs someone else for help. So, but it's all about chasing AUM, and there's the basic thing notion that on average funds don't earn better than investing in the index, which has given rise to this passive investing, which is a bit worrying. If everyone's a passive investor and no one's doing the research, then we've got a real random walk down Wall Street, haven't we?
Absolutely. You have a chapter on special situations, which for value investors have been a mainstay ever since Joel Greenblatt's book, or even before that. Um, so, uh, just tell us what you mean by special situation in the context of financial statement analysis, and a quick overview of how your approach can be applied in cases like turnarounds, restructurings, or other non-standard scenarios.
Yeah, the special situations are those particular situations, and you mentioned turnarounds and restructurings. We don't cover that there. On the chat we only cover two things. One is insurance, property casualty insurers, okay, and the other is acquisitions, M&A. And it's how to actually evaluate the valuation in an insurer, property casualty insurer. The drivers are very, very different. The idea of the float and generating the float and earning money from the float by investing that float in other assets, in other businesses like Berkshire Hathaway does, like Markel does, or buying securities, and how the cost of getting a float is, of course, lower premiums. That gives you a higher combined ratio, the loss ratio. So that's what's going on. But it's all within the similar the same model. Work with income statements and balance sheets. understand the float from the balance sheet and how the model, how that float can change over time, and the income statement about how much the cost of getting the float, which is actually the loss or the slight profit you're earning on the insurance side, is being earned. On M&A, it's a question of applying the same principles of the book to, yeah, it's you're just buying another company, and how you might do that, and in particular, how you split the value from how you split the value from an acquisition with the so-called added values, how that's split between the target firm and the acquiring firm. Um, there are a lot of difficulties there. There are accounting difficulties. The accounting for acquisitions is bad. Here's one example. What's this goodwill number? It's a plug. We're supposed to impair it. What the hell's in it? Okay. I have done some work to actually generate an alternative accounting for goodwill and for acquisitions that actually get to the heart of what's being generated and what's there to be impaired or otherwise maintained on the balance sheet. So the other two we look at. There's a case there on restructurings. Coca-Cola's restructuring, a number of restructurings at one time. It's had the 49% equity in the bottlers, the 49% solution, and then it decided to acquire the bottlers. And now recently, last few years, it's decided to offload those bottlers and distribution companies. So there's a restructuring going, how you think about the value generated in restructuring. That's not in the chapter, that's in a case that goes along with the book.
What I've always found interesting when it comes to M&A is how automatic it is that investors exclude intangibles amortization from their assessment of earnings when actually a company paid that money above and beyond the value of the assets of the acquired company. And so while it makes sense to exclude that amortization to when you're assessing the underlying business, the returns on the underlying business, but not when you're assessing the returns on your M&A necessarily. I mean, I feel like maybe there's a deficiency there in how investors look at that.
Yeah, I think the problem here is with the accounting. As I say, this accounting needs to be completely redone. And I do have a paper if people are interested on a proposal of how to do the MA accounting differently. But no, you recognize these are tangible assets that are purchased. And that's a little bit putting your finger up to the wind. Now, what's the value of the brand? What's the value of this? And what's the value of that? So it's a bit of a fluffy number. And then if you've got to amortize it, and you only amortize it with definite lived intangibles booked, not with indefinite lived, not with the indefinite lived, then the amortization number it's added back because it's a fluffy number too. Okay. And this is like the old days when goodwill before before FASB statement 142 and 143, goodwill used to be amortized. And the standard thing used to be amortized over 40 years. Um, uh, uh, Analysts always added it back and said, this is just an arbitrary number, okay? Following a rule, you add it back. It doesn't make any sense. So you don't want numbers that analysts say, it's too fluffy, I had it back. Because one thing is that there is some amortization. If you have a copyright or you have a patent that's going to expire in 25 years, well, it's going to expire. There's going to be a cost. You've got to recognize that. It's a question of how you do the amortizations.
So maybe we can finish it up by talking a little bit about the future of value investing or how it needs to adapt in this modern economy, knowledge-based economy with more and more intangibles driving value. What is your view on the relevance of value investing, and what, if anything, needs to change to make it more relevant?
Well, in some sense, I think, all investing is value investing. We're not going to escape that one. It's a question of how you go about it. I mean, when you're buying a stock, when you're buying a firm, you're buying payoffs, and it's a question of what you want to pay for those payoffs. Okay, so you've got to get some grip on that. And the question is just, just how you do it. So I think, no, people will gamble, of course. People will gamble on all sorts of things. They'll treat it as a casino, and they're free to do it. That's fine. You can gamble, but for someone who's a little bit risk averse and says, maybe if I just pull in a bit of information, I'm not going to get rid of all the risk. And maybe I'm left with a lot of risk, but I can actually reduce my risk by bringing in some information. I think that's always going to be there for the those who want to put some effort into it, those who want to do some work. Those who don't want to do that or to feel they can't do it, well, yes, if you want to share in the fortunes of America, just go and buy the S&P 500. You'll share in the disappointments in America, the downs, all ups and downs. But yes, just go and do that. That's okay. But for those who have some equipment and some understanding to actually press on it, is always going to be there. So you might say, yes, I'm going to buy the S&P 500, but let me go through and just look at a few companies. If there's a lot of speculation around, I cannot really justify it. I may strip them out, okay? Or I may be left with an adjusted S&P 500 with firms stripped out. I don't have to go the full Monty. But where's value investing going? In answer to your question, well, I think the basic discipline of value investing is on the table. It's been there for a long, long time, laid out by people like Keynes and Benjamin Graham and so on. Okay, the basic attitudes are there. I think one of the important things for an investor is just to have a lot of common sense. Okay, bring that common sense to it. Understanding the business, I think that'll always be there. Now, in terms of technical innovations about how you might do it better, well, I think information is gold. So the ability to grab more information about outcomes that may help us improve it. There's a lot of difference between when I started investing. I was like Warren Buffett. I go to the Moody's manuals and read what's in the Moody's manuals. Okay, this is way before the internet and everything else. Now we can scrape information with satellites and all sorts of things. Okay, so that trend in getting more information is going to be important. But I think the basic approach to it is probably not going to change. Now you're probably going to ask about AI. I don't know. I'm not sure it can actually do the creative thinking that a human can do when it comes to value investing, of understanding the business and combining that together with the account. It can do a lot in terms of bringing the information to you, but I don't know. I'm just an observer. Let's see what happens there.
Professor Penman, is there anything we have not covered that you'd still like to leave our members with before we part ways?
I think there's a certain person who's adept at being certain personal characteristics which are good. So just keep that in mind. First of all, this is not for day traders. This requires serious long-term thinking. It requires discipline. It requires separating yourself from the herd. Yes, you've got to read the Wall Street Journal, the Financial Times, and pick up the news, but do it with a distance. Okay. Be skeptical. Uh, challenge the thinking. Challenge the normal thinking. Um, uh, be very thorough. Do your homework. I think these are very, very important attributes. In my mind, the most important attribute for a value investor is beware of self-deception. Um, I find this is one of my biggest problems. Oh, I've written a paper. I like that paper. Well, you can like the paper. Let's take it at a distance, okay? My kids growing up, they're grown up now. They tell me the biggest danger is self-deception. As a lot of that a teenager has, okay? Um, beware of your self-deceptions. Test yourself. Bring the data to yourself. Negotiate with Mr. Market, okay? But don't think you know everything. Say, well, what's he know? What does he know that I don't know? Why has he got a different opinion than this and I have? Turn it back on yourself. That is what I call being honest. Of course, it's not just being professionally honest, which is very, very important, but it's being honest in yourself. I think that's a very, very important attribute to have. Don't kid yourself, boy.
Well, on that note, Professor, thank you so much for taking the time to have this conversation. It's been really packed with wisdom and insights. And I can only warmly recommend your new book to all of our members and listeners. Truly appreciate you doing this with us. Thank you.
Thank you very much, and it's been good talking to you. And by the name, my name is Stephen, not Professor Penman.
Okay,
So,
noted for next time.
okay, very good.
Best wishes. Thank you so
Cheers.
much. Bye
Okay.
bye.